Hello and welcome everyone to this weekly market recap for the week ending Wednesday, February 12th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. It's a pleasure to be back with all of you this week. Um, we got another inflation report out. It was hotter than expected. We got the core CPI for the month of January out this morning, 8:30 a.m. Eastern Standard Time before the market opened. And it was hotter than expected, came in rising 0.4%. Market was expecting 0.3%. And if you just multiply that out, 0.4 times 12, that would get you up near 5% inflation rate. Now, the 0.4% did come in, higher than what we've seen in recent months. And it could just be simply a temporary pushback to the upside, but it definitely spooked the market. We saw futures drop. We did get some movement back up in the market later in the day, which is good. We've been seeing a lot of that resiliency of late. I mean, the last few weeks, if you think about it, we've had the DeepSeek news out of China. We had a Fed meeting a couple weeks ago, 2 weeks ago. We had the tariffs that have been announced by President Trump. We got the inflation numbers out today. There's a lot that the markets had to deal with, and you might be looking at some of the numbers and saying, yeah, so what? Market doesn't care. S&P 500 still near an all-time high. I'm not worried about any of this stuff. Well, I'm going to show you a couple of below the surface signals today, and maybe you might think a little bit more about that when I show you what's going on and what it could mean for the market. But let's go ahead and jump in, take a look at what happened over the course of last week. Again, a reminder for all of you, I'm looking back to the close last Wednesday through the close this Wednesday. Kind of an awkward weekly look at it, but just want to make sure you realize that weekly period I'm talking about, not just this week, but also going back to the Wednesday close of last week. I know that, like I said, major indices, as you can see on the screen, over the course of last week with the jobs report last week, jobs came in lighter than expected. Average hourly earnings were up more than expected. I think the unemployment rate dropped just a tad. Overall, it wasn't a horrible report, but it also wasn't a great report either. So I think there's a lot for the market to try to digest here. And the way I'm seeing it is not so great rotation. But again, I'll talk about that in a bit. Transportation over the last week is your winner, rising over 1%. NASDAQ 100 rising a little bit more than 1/4%, and then the others in negative territory. Small caps and mid caps, especially getting hit harder over the course of the last week or so. As the Fed continues to talk more about inflation and maybe interest rates being pushed further down the road, that's kind of what came out today. Fed Chief Powell spoke this morning after the CPI report came out, and I almost kind of felt like he was a little bit more dovish at times when he was talking, although he did come out and say that the Fed has made great progress. That was a quote that he used, which I thought was saying, hey, well, all of a sudden, last time he was speaking it was all pretty hawkish, and now he's saying, hey, we've made great progress, we're almost there. So it's almost like, I don't know, he's kind of editorializing what's going on. I don't know. I just don't get great vibes. Just again, that's me. I don't get great vibes from this Fed about what's going on. I felt better after he talked today than I did last time when he was talking. But anyhow, we'll see how all this plays out. But I thought it was interesting to see small and mid cap stocks underperforming again, because that kind of brings us back to where we were back before the summer of 2024, back when, the market still wasn't, certain that we were going to get those rate decreases. But then after that June CPI report came out, it was mid-July, maybe 10th, 11th of July, things started changing, and there was rapid rotation into small caps and mid caps because of that decrease in the June CPI came in way below expectations. And so that got the market thinking rate cuts were coming, which they did eventually. And so now we're just dealing with, how the Fed's looking at inflation right now and when that next rate cut might be. But based on this morning's CPI, The betting later in the year and the next rate cut, if and when it comes, will be later in the year than what was previously expected. There were still odds that we were going to get a rate cut in June, and that was pretty much squashed with this CPI report this morning. So I think that's part of what we're seeing going on with the small caps and the mid caps. It's kind of like we're going back to where we were, at least for now, until we get some other data to come in. Looking at the individual sectors, I just really wanted to make one point. So we saw the S&P 500 relatively flat for the week, but I want you to look at what's going on with consumer stocks. Consumer staples, the defensive area of consumer stocks, gaining 1.8% over the last week. Consumer discretionary, which is the more aggressive area of consumer stocks, dropping 2.37%. So the S&P 500 staying flat, but all of a sudden the money is rotating out of discretionary and into staples, out of an aggressive area of the market and into more defensive. And then you look at the only other group that's been up or that was up last week more than 1%, and it was utilities, another defensive group. So this wasn't the best setup in terms of sector performance over the last week when we look at how the S&P 500 performed. So I just wanted to make sure we pointed that out. Looking at the S&P 500, I mean, we're really going nowhere. The last 2, 3 months, we topped back in December, and really where we sit right now is not much different than where we topped shortly after the election, the first week after the election it looks like around November 11th or so. We're not much higher than where we were then, less than 1%. So it's been kind of this flat sideways action, but I'm a little bit concerned with some of the rotation that's been taking place. And again, I'm going to get to that in just a few minutes. NASDAQ 100, you can see here, we had a big move today up off of the gap down with the CPI report coming back up. And again, I think a lot of folks are kind of reading into this that, hey, that's good news. Well, it probably beats the alternative of gapping down and selling off all day. But still, no breakout. And you just wonder how many times the bulls can go to the well and come out, smelling like roses after we get some bad news. So as the bad news keeps building, I'm just afraid one of these times it's not going to come back. We're kind of all getting trained that every time there's bad news, it's a buy. We saw that with DeepSeek. We saw that with the tariffs the following weekend. We just saw that again today with the CPI. Gap down, rally, gap down, rally, gap down, rally. What happens maybe next time we get a gap down and things don't quite come back the way we hope? So anyway, that's something to keep in mind there that on the NASDAQ 100. Small caps, again, you can see a little difference in the chart here. Small caps going back down, testing that low that they saw back at the beginning of February, and quite a bit off of the high that we saw back in November. And we were up at 245, and now we're back down at 224. I mean, this is almost a 10% drop from the high. That's a totally different picture than what we've seen on the S&P 500 and on the NASDAQ, where we're still not that far from trying to make a breakout. As I move to the sectors, I mentioned the XLY and the XLP. So I just wanted to show you, look at what's going on here in February. So we're still hanging in there in the major indices. We're still rallying back, but the more aggressive consumer discretionary area has actually been going down almost every day this month. So we've been rolling over and moving lower. And yet you look at the other side, consumer staples area, which is more defensive, and look at what's been going on here now for the last 3 or 4 weeks. Money rotating into defense. So the S&P is kind of going flat, but now we got money rotating into the more defensive area and away from the more aggressive area in the consumer space. So that's a little bit of a red flag for me. How about the IWF? So here's the IWF, went up, set a high in mid-December, kind of going sideways. Now the IWF is an ETF that tracks large cap growth. The IWD, which I'll show you in a second, that tracks large cap value. So here's the IWF, large cap growth. We made a high in December. We got a double top in play. Can't quite get the breakout, just kind of going sideways. Value, meantime, had a very rough December and early January. So it's like, okay, growth outperforming value, but look at what's happening now over the last 3 to 4 weeks. I've been talking about being a little bit more cautious in the market, and I think this is kind of underscoring what I'm talking about. This defensive area, the more value-oriented stocks among large cap names, is rising and staying up near the highs. Whereas when we look at the growth names, we had the highs and now we're starting to roll back over again. So this is a relationship that we really want to continue to follow. And the best way to look at this is using the RRG charts. Joyce de Kempenaar, a really good buddy of mine, I got to say he's brilliant. I mean, coming up with the RRGs the way he did, and the way that you can, if you're a member at Stockcharts, the way that you can customize these. I'll show you visually what I'm talking about in terms of money rotating and what this could mean to the market in just a minute. But I want to show you as a free member at Stockcharts, this is what you get under the RRG. No customization tabs over here. You've got the S&P 500 as a benchmark, and you've got several of the other major indices as, you know, you're kind of looking at the rotation of those indices versus the S&P 500. Well, I mean, that's not really giving anything under the surface where we can really evaluate the market. I mean, this in essence is just kind of showing us some of the different ways that stocks in the US are kind of put together. For the most part, this doesn't really do a whole lot for me. But as a member, let me show you what you can do because this is pretty cool. So here's the S&P 500. I could go through and, you know, first of all, look at all the different groups. It's already customized where you can go in and just, you know, put in whatever you want, and it's already going to show you how the members of each group are performing versus the benchmark of that group. Already set up for you, which is pretty cool. But what I want to do today is just kind of show you visually what I'm talking about in terms of growth versus value by using the RRG and becoming a member at Stockcharts. I've been a member, probably 2 decades, close to 2 decades. And so I'm spoiled being able to use all these cool features and tools. But look at the S&P 500 and look at where we are right now. So the IWD is on the right side of this RRG, which means on a relative strength basis, it's been a relative strength winner. When you're on the left side, you're a relative strength loser relative to whatever the benchmark is. So right now, growth is on the left side versus the S&P 500. Value is on the right side. This is where we stand right now as we're evaluating the S&P 500 and the NASDAQ trying to make a breakout. Now, I'm going to take you back throughout the year. Just try to do this pretty quickly. But usually when the market goes up, what you'll see is the IWF moving over here on the right side of the chart and value over here on the left side of the chart. And then when the market goes down, you see the opposite. But sometimes as you're moving up, so right now we're moving up, and look what's over on the right side. This is back in March of 2024. So just under a year ago. As we get up to this top, you can see the IWD is actually, for the most part, outperforming as we top. Remember, we had a big drop in April? At the very top, look at what value is doing versus the growth area of the large cap asset class. Here you can see anytime you're moving up, momentum is building, and anytime you're moving to the right, relative strength is improving. So you want to move in this northeasterly fashion. So your momentum is building, and also you're getting great relative strength. And anyway, when I grab this, as we start moving down in April, you can see value performing pretty well. We get to the bottom, and then starting in early May, I want you to watch this turn because now the S&P is just getting ready to go into this move to the upside. And so now, as we do that, look at the IWF come back and move, and it's definitely outperforming value as we move up. Look at this. So that's great. But now we get up to this level, we go sideways for a bit, we see value start to come back a little bit, and then we start to make this final move to a top in July. And now, as we reach the top, look at what's going on as value starts screaming back. So that's a little bit of a warning sign. We're reaching a top, and now money is rotating into value. Money should be rotating into aggressive areas. We want money to rotate aggressively with risk, a risk on market environment. And when you reach a top and you see value start doing that, now look what happens as we go down. Now value is just clearly crushing growth. And now we get to the bottom and look at what happens now at the bottom. And as we start moving back up, now all of a sudden growth is coming roaring back and takes the lead. Anyhow, we could go ahead and go through this. I don't want to take up too much time, but I want to show you one other RRG chart. And that was going back. This is at the end of 2021, early 2022. So this is where growth stood in November of 2021. Things started to deteriorate here over the course of the next month and a half. And I'll show you as I drag through time over the next couple weeks or next several weeks until we top. Look at what is happening. The market is staying up near the high, but all of a sudden we get toward the end of December and into early January, and look at what has happened at the final high. That's January 3rd, 2022. At the final high, money has rotated back into value. Now, what that tells me under the surface, Wall Street is already rotating while the market's at a high. Wall Street's already moving out of growth and into value. Meanwhile, we're sitting there thinking, oh, everything's perfect. Yeah, maybe we had some bad news coming or whatever, but market's back near its high. It's setting new highs. Market's in great shape. It's not what I said back at the beginning of 2022. From using some of the tools at Stockcharts, it's pretty easy to make some calls that go against the grain. But look at what happened. All we needed was price action in January to confirm the likelihood of a cyclical bear market. And look as we started to roll over. Look at the money pouring out of growth and into value. And, we had some periods where we would start to rally in growth, not so great in value, and then we would simply roll back over again. Well, here in late March was the final chance. And if you look, sentiment, I mean, everybody was bullish again. It was pretty wild period. But as we got to the end of March, look at what happens. I remember writing articles and doing shows and saying, this ain't the end. We're going lower. Don't buy into these growth stocks. And look at what happened after this. Here we go. Back down again on growth. And now the growth or the value area is living on the right side until June 17th. And it was right there that I called on YouTube. You can go back and look it up. I said, market's bottoming. This was one of the reasons. Money was starting to rotate back into growth. And over the next 2 months, the S&P 500 went up 700 points. And look at the money rotating back into growth here. And then the Fed came out. My buddies over at the Fed. That was on August 26th. And right here, 26th, right there, that's when Fed Chief Powell said more pain ahead. And we ended up going down one more time, and look at growth going by the wayside, value come roaring back. And that was the case until we got into 2023. And in 2023, right here at this last bottom, January 10th, that's when things started to change and then the growth went over. Anyway, these kinds of relationships are so important to keep an eye on. And the tools are right here. The RRG, you're not going to find this anywhere else. This is exclusive at Stockcharts and one of the really, truly great features being a member. Just getting used to watching all of these different rotations, I think is, worth its weight in gold. All right. Coming up on Monday, I do want to talk a little bit about EarningsBeats. We've got a huge event coming up. It's our top 10 stock picks. I call it the draft. Imagine the NFL and you're sitting there and you got the top 10 picks in the draft. I can target every one of my weaknesses, to get better. I can go after, wide receiver. I can get another quarterback. I can get offensive lineman, defensive lineman. I can get cornerbacks. I get the top 10 picks. My team's going to be a lot better with the top 10 picks. Look at the stock market, and you should be thinking the same thing. Thousands of stocks out there. Pick the 10 best ones. Pick the ones that are leading the market, because that's how you're going to beat the market. If you try to beat the market with stocks that are going down relative to their peers, Good luck. Not the way the market works. It's not the way you're going to beat the market. You're going to beat it with leading stocks. And so, a couple of things here. Number one, if you go over to EarningsBeats, you can start a 30-day no-cost trial, or just click on this link and it'll take you over to this landing page where we have outperformed the S&P 500 by 2.5 times since 2018. Incredible outperformance. Look at this chart. Since we started back in 2018, look at what our model portfolio has done relative to where you would be just following the S&P 500. And the way we do it is with relative strength. Anyway, we rotate stocks every 90 days. We're coming up on that 90 days on Monday. So we are going to be announcing the 10 stocks that are going to be in our model portfolio for the next 90 days. Also, the 10 stocks that are going to be in our aggressive portfolio and income portfolio for the next 90 days. If you're on your mobile device right now, you can simply scan the QR code. That'll take you to this landing page. You can sign up. We have a free 30-day trial. You have to give your credit card. But if you don't like the service after 30 days, cancel. In fact, we'll even remind you before your 30 days are up, that you're going to be charged. And we'll give you a special offer on an annual membership. And if you don't want it, then you just cancel. And we make sure that you don't get charged. All right, last thing I wanted to do today is just quickly go over stocks that have reported after hours. You can see Cisco up nicely, up 6% after hours. Others not so much. App, though, having a huge after hours session, gaining $108, which is another 28%. This has just been one of the best stocks in the market for a while now. And just see it's showing no signs of slowing down at this point. Now you got Trade Desk. So Trade Desk, on the other hand, you can see the stock down $33, 27%. I haven't seen any results. I'm just seeing the reaction in the market. Obviously, market initial reaction's not good on Trade Desk, down 27%. We'll see how it reacts in the morning after it opens up. Next, Robinhood up 14%. So this one's gone up from 56 almost to 64 in after hours today, getting a great reaction there. Reddit down 16% after hours, $35. We actually exited all of our portfolio stocks a couple weeks ago. We were just really nervous. We just moved everything into cash. Reddit was in one of our portfolios. I think it was in our aggressive portfolio, but we avoided a 16% drop by being in cash, which thankfully is all I can say at this point. Next up, MKS Instruments, MKSI down about 3.5% after hours. Rapid7, this is another software stock, down 6% after hours. And Upwork, right now up 47 cents, which is about 3% after hours. And Fastly down 21% after hours. This is a stock that had been going up, been in a nice uptrend, was up over $10. Now tomorrow it's going to open down here somewhere, probably around the $8 area, taking out recent support levels and lows. So not looking good there. Anyhow, you can see with earnings, prices are all over the place, some reacting positively, some negatively, and hopefully you can see the risk involved in holding any stock into earnings. Some will work out great, others not so great. If you're like me, you'll probably be in the one that's not so great. But that's it for me. I do want to mention, if you want to follow us at EarningsBeats, you can simply scan on the code on your screen now, scan that code, and it'll take you to a landing page where you can find out more about us and where you can follow us. So that's about all I got. We got another PPI report coming out tomorrow morning, as I mentioned earlier. Not a lot of economic reports this week. It was mostly inflation. We do have retail sales coming out on Friday, so that'll be watched closely to see how the economy is holding up with rates remaining higher for longer. But yeah, that's basically where we stand right now. I'm still a little nervous about this market. I will point out, once we get past Friday, we start the second half quarter. And so the second half historically does not perform nearly as well as the first half. Earnings are now behind us. And what I've been telling members is, what's the catalyst? Where is the catalyst that's going to, all of a sudden jumpstart the market to the upside? I don't think the next couple months we have one until we start getting closer to earnings in April. So I think these next few weeks could be a little dicey. We'll play it by ear. I mean, obviously, no guarantees. I just think with the money rotating the way it is, like I showed you, away from growth and into value, away from discretionary stocks into staples, these things generally don't work out well after we see this kind of rotation. So we'll see where we go from here. But for this week, I'll sign off and I'll be back next week to go over everything with you again. Have a great week, everybody. And I'll see you next week. Happy trading.